Hello and welcome. In today's video, we are looking at Maruti Suzuki India. We will first of all go through its core details or important details about the company, what it does and where are its plants, what does it manufacture and so on. Then we'll go and understand the financial statements, that is the profit and loss account, balance sheet, cash flow statement, quarterly P&L account. All of these statements are important to understand. Then we'll look at the main important ratios, the core ratios, and also compare it with its peer group companies. And finally we'll look at the chart on the graph where we can buy, at what levels or at what prices can we start buying into the company's shares. So let's begin with basic understanding of what the company is about. Maruti Suzuki India was incorporated in 1981. It's a market leader in the domestic passenger car industry. GOI, that is the Government of India, and Suzuki Motors in 1982 entered into a joint venture agreement where the Suzuki Motor acquired a 21% stake in Maruti Suzuki India Limited. So basically it's a joint venture between GOI and SMC. In 2003, the ownership structure changed. Suzuki Motors increased its equity stake to 54.21%, making Maruti its subsidiary. Suzuki Motor currently holds 56.21% stake in Maruti Suzuki. By September 2007, government had offloaded its entire equity stake to the Indian financial institutions, including banks and mutual funds. So basically, as of now, GOI does not have any stake in the company. Suzuki Motors has a subsidiary, Suzuki Motor Gujarat Private Limited SMG, which was set up in Hansalpur in 2017, Gujarat, to cater to the increasing market demand for the company's products. This is a new facility and an additional annual production capacity of 0.5 million units was available through this particular unit. The SMG or the Gujarat facility or the unit is in the process of expanding production capacity to 0.75 million units by 2020. Maruti has a dominant market position in the domestic passenger vehicle segment. It is reflected in its market share of over 50% during the 9 months ended 2018 December against 47% which was there in fiscal 2017. In the first 9 months of fiscal 2019, the domestic passenger vehicle volume grew by 4%, and MSIL, that is Maruti Suzuki registered a 7% growth, whereas the domestic passenger vehicle volume grew by 4% in the first 9 months of fiscal 2019. And that was due to successful launch of new models as well as healthy performance of the earlier models, including Alto, Swift and Dzire. In the past also, the company has successfully launched many new models: Ignis, Baleno, Vitara Brezza, New Swift, New Ertiga, New WagonR in the mid to premium segment, and that has helped it improve its product portfolio. And the success of existing model combined with the overall product portfolio which is expanding has led to its dominant market position. In the recent past, Maruti Suzuki had 5 to 7 models in the list of top 10 models sold on a monthly basis. Over the medium term, company is going to launch new models in the mid to premium segment while also focusing on the entry level segment. It is also launching NEXA dealership, which is selling premium models, and it will enhance its presence in the mid to premium segment. Maruti Suzuki has a very good association with its parent, which is Suzuki Motors Corporation, which has extended product development support as well as shared technological expertise and provided access to a broad product range. Company's plant 1 at Gujarat was completed, and it also started commercial production from 2017 March, and its annual capacity is of 2.5 lakh units. In Jan 2019, Suzuki Motors Gujarat completed the construction of Plant 2 and started production also. Plant 2 also has an annual capacity of around 2.5 lakh units along with Plant 1, which also has 2.5 lakh units. And they also have Plant 3 under construction, which is already begun, and it is expected to come online by 2020, taking the total capacity of this Gujarat plant to 7.5 lakh units annually, and the total cumulative capacity of Maruti Suzuki with all its units is 23 lakh units. Its operating efficiency is among the best in the industry, and it is supported by continuous process improvement, and it also has a very good linkages with its component suppliers and flexible manufacturing processes, which also results in a very effective cost control. Operating margin has been stable at around 15% because of higher average realizations, favorable commodity price movement, cost reduction initiatives, lower discounts and localization efforts. While operating margin may moderate owing to adverse commodity prices, higher marketing spend, higher discount offered by the company to normalize channel inventory and shifting of additional production to the Gujarat plant, it is expected to remain healthy at around 13% or more. MSI has also maintained its strong financial risk profile with large net worth and liquidity of around rupees 42,000 crores and rupees 34,000 crores respectively. The company is debt free due to its strong cash generating ability. Its key credit metrics, debt to equity as well as other metrics, they are at a very good levels due to low requirement of debt and primarily funding its capital expenditure, that is capex, through internal cash accruals. The Indian passenger vehicle market is very competitive, and there are existing and new players which are launching new models regularly, especially in the compact and mid-size segment. The number of players in this segment increased to 17 in fiscal 2018 from 7 which was in fiscal 2008. And with more players and models vying for a share of the growing pie, competition in the domestic car market is supposed to intensify, resulting in price competition and lower realization. Maruti's presence in the premium passenger vehicle segment, though improving, is very modest. This segment is witnessing higher growth than the entry and the sedan segments. Maruti's market position and operating profitability will depend on its ability to launch successful new variants and models in the domestic market. The company is exposed to risks related to fluctuations in forex rates because of its large imports, royalty payments and export direct and indirect raw material imports, which constituted around 15% of the total net sales. Besides, the company also has yen exposure for royalty expenditure amounting to around 3.5% of the net sales. During 2018, the parent company Suzuki Motor approved a new method of calculation of royalty, wherein for all new models starting Ignis, that is Ignis, Dzire, New Swift, Brezza, New Ertiga and New WagonR, royalty will be paid in Indian rupees. Once a particular level of volume is achieved, royalty will come down. And this is likely to reduce its exposure to forex fluctuations over the medium term. Exports constituted 7% of the total volume in 2018 and partly provided a natural hedge for the forex exposure. While MSIL hedges its forex exposure, the company's operating margins will remain vulnerable to fluctuations in the forex movements. The company has ample liquidity and it has a very healthy cash accrual of almost 8,000 crores for 2018 and also large liquid surplus of around 34,000 crores as of March 31st, 2018. The cash accrual and surplus are more than sufficient to meet its incremental capex plans and working capital requirements. It also has large unutilized bank lines. The company will most probably maintain its dominant position in the domestic PV segment with a large and successful product portfolio, strong distribution network and access to Suzuki Motors technology. Financial risk profile is expected to remain healthy because of conservative gearing, that is debt to equity, excess or surplus liquidity, and incremental capex funded entirely through the internal cash accrual. The company has manufacturing facilities in Gurgaon, which has 2 plants, and Manesar, where there are 3 plants, along with Suzuki Motors unit in Gujarat, which is 2 plants, and total installed capacity is around 2 million units per annum. The company currently has 16 models with over 150 different variants across segments. These include the mini segment, which is composed of Alto 800, Alto K15 and WagonR. Then we also have the B segment, where we have cars like Swift, Celerio, Ignis, Dzire and Baleno. The C segment consists of Dzire Tour. The D segment, which is the mid-size segment, consists of Ciaz, and the van segment consists of Omni and Eco, and the SUV segment consists of Gypsy, Ertiga, S-Cross and Brezza. So this concludes my overall understanding of the company, what it does, what kind of product it has, what is its financial position, and now we'll move on to analyzing the financial statements of the company. Okay, let's begin our analysis of Maruti Suzuki India. We'll begin with the P&L account analysis, and starting with the sales growth rate, CAGR growth rate over 5 years, 3 years and latest. In the recent 12 months, the overall sales has fallen by 8.3% from where it was in 2019. From 3 years back, that is March 16, the overall sales has been growing at 14.3% compounded. So it's a good sales growth rate. In 5 years, we see a 14.08% growth rate. That is from March 14 onwards, 44,000 crores to 86,000 crores in March 19. So overall, in the recent 12 months, the volume has dropped. But we'll have to see for the entire March 2020 whether the sales is growing. And right now, overall automobile sector has a lot of issues and problems overall. So that we can see that is getting reflected in the overall sales volume that we see here. The operating profit margin since last 3 years is at 14.3%, and in the last 5 years it was 14.4%. March 19, the margin had dropped to 12.8%, and in the recent 12 months it is further fallen to 10.2%. So there is definitely margin pressure on the company's overall sales. We can see the overall sales in the recent 12 months was almost 79,000 crores, and in compared to that, the operating expenses were 70,000 crores. So it is very high compared to its sales. That is, the expenses are very high compared to its sales. Other income percentage contributing to the total sales value, that is to the profit, in the recent 12 months 3,400 CR came through other income, that is almost 4.4%, which is reasonably low when compared to the total sales. So the contribution of the other income has been increasing from 1600 crores to 2007 and 3400 CR. And if someone doesn't want to listen to the commentary, they can just look at the graph and quickly go through the video. You don't need necessarily listen to the entire video. If you are aware of the format that I follow, and if you've already understood how I analyze the companies, then you can just skip through this commentary and straight away just look at the chart and figure out for yourself if this company is worth investing. Depreciation percentage as a total of sales. In the recent 12 months, depreciation cost is 3,500 CR. Other income is also contributing around 3,400 CR. So it is very nearby, depreciation and other income. And that is just 4.5%. So it is also very reasonably maintained in terms of sales when compared to the sales. So this is a good value. There's quite a stable depreciation value being charged throughout the years, which basically gives us a confidence that the company is not manipulating its account in terms of depreciation, not reducing its profit and loss account values when we look at the depreciation being charged. The raw material cost for this manufacturing company is very high at around 70%, and it has been there throughout these years. In fact, they have slightly reduced it as a total percentage of sales. In March 19, it occupied around 70%. That is, raw material occupied 70% of the total sales. Employee cost is very stable at less than 4% throughout the years. In all these analysis, graph analysis, ratio analysis, we are trying to find faults, red flags, and potential problems. And if we cannot find those problems, then we are looking for stability and a growth, upward trend, and so on. Basically, either we find faults or we want to look for stability and upward growth rate. Interest expenses are very low at 114 CR in the recent 12 months, which is a very small 0.1% of the total sales. This itself means that the company is almost debt free. Tax rate, company had paid in the recent 12 months 21% of its sales as taxes. So 1653 CR went into tax. Now what we are looking for in this particular ratio is stability. Is the company manipulating a tax liability? And if we see March 16 to March 19, it was about 25%. In the recent 12 months, it has dropped to 21%. So if the company is deferring its tax payment, then it will basically inflate its profits. And if it's paying its tax liability in advance, then that will deflate or reduce the profit. So basically we want to see a stable tax rate structure throughout the years. In the recent 12 months, it has its tax liability has reduced to 21%. Interest coverage ratio, as we saw earlier, the company's interest payment was very small. Therefore, its coverage at 69.6 times of EBIT will be very high. So overall, if we look at its, we don't need to actually investigate the overall multiple of interest coverage ratio because it will always be very high. What you can look here in this particular chart is the EBIT trend. In March 16, the company earned 7,600 CR of EBIT, earnings before interest and tax. In March 19, that increased to 10,700. Now in the recent 12 months, that has again come back to around 7,900. So we can see a downward trend as of now, until unless the overall sector comes back up again. Right now there is a lot of problem in the automobile sector, because of which this is getting reflected in the chart as well. Net profit margin on the total sales, how much net profit was earned. The company's NPM margin has been falling from 16 to 19 and the recent 12 months to 7.8%. That is, its total sales done in the recent 12 months was around 79,000 CR. On that it earned 6,100 CR. That's a 7.8%. In March 19 it was 8.9%. So overall the margin trend, that is net profit margin trend, is dropping. We'll also need to look at the cash, how much cash the company is earning, and use that to understand if the company's overall cash profit margin is improving or not. Average NPM through 3 years and 5 years has been at around more than 9%. So when we look at 1 year, that is the recent 12 months, it seems to be at a very low value. But when we look at the 3 years and 5 years values, it is quite reasonable at 9.9 and 9.4%. So 1 year can be misleading, and I don't make my decision based on 1 year of data. Let's see how the profits have grown. In the recent 12 months, the profit has fallen by 19.2%. We saw in the first graph about the sales growth, where the sales also had dropped by a certain something around 8%, and the profits have fallen by 19% compared to 2019. In the recent 3 years, it is still positive at 11.6, and from 5 years back, it is growing its profits at the rate of 21.8%. So this is still good. We don't want the profits to be falling too much compared to March 14 value. anything above 10% of growth rate from March 14 onwards is a good value. Valuation ratio, market cap to sales. In the recent 12 months, the company is available at just 1.9 times its sales. It had done a total sales of 79,000 crores, against which its total market value was 1,47,000 CR. So this is a good valuation as of now. It is almost available at the March 16 value of 1.9 times. But when we look at the market cap, in March 16 it was at 1,12,000 crores. In March 19, in 3 years, it increased to almost 2,01,000 crores. And in the recent 12 months, the company's market value has dropped to 1,50,000 CR. So this gives us a good buying opportunity as of today. So from March 16, if we see, the overall market cap has increased as well as the sales has increased, and the ratio is still at 1.9 times. So this gives us a confidence that this ratio or this multiple is a good one. Dividend payout, how much of the net profit was given out as dividend? In March 19, 31% of the profits was distributed to the shareholders as dividend. Out of this total profit, 2,400 CR was given out as dividend. And if we see, the dividend payout has been increasing consistently from 14 to 16 to 19. In March 16, 19% was paid out as dividend. Price earning ratio, that is what is the price that you are paying for each share against the profit being earned for that particular share. So we don't want to pay a very high multiple. In the recent 12 months, or the latest price earning multiple has come below my benchmark. The current price earning is 23.8 times. That is, for a profit of 204 rupees per share, we are paying 4,878 rupees. This is the latest price as of today. Today is 27th March 2020. In March 19, the multiple was above my benchmark of 25, and in March 16 it was at 20.4 times. So we are getting at a good multiple of 23.8 times. If you look at the average of the last 3 years, it was always available at 28.2 times its earnings, and in the 5 years it was available at 26.9 times its earnings. So we are getting the latest price earning below its averages. Let's continue with the balance sheet analysis. The overall equity share capital has been always very stable at 151 CR, and the face value is also very flat at 5. So the company has not manipulated or diluted its equity share capital or its face value from March 14 onwards. Return on equity, how much profit the company is earning on shareholders' contribution. In March 19, the company generated around 16.2% of ROE. The total profit earned was 7,700 against equity contribution, that is equity plus all reserves, of 47,000 CR. And if we look at the percentage trend, in March 14 it was 13.3%, in March 16 it was 18, which increased, and in March 19 it is still above my benchmark of 15%. Let us look at the averages of the last 3 years, 5 years and 7. If we see, in the recent 3 years, the company's ROE was 18.3%, and in last 5 years it was at 17.7. So overall, if you look at for all 3 years and 7 years, we see above 15% of return on equity. So 1 year of fall below 15 should not make a big difference to us. Return on capital employed, that is on the total debt plus the equity shareholders contribution, how much was the EBIT that was being generated. In March 19, company managed a 22.6% growth in EBIT against its total capital employed. So this is a very good value. Anything above 15 here too is a good value. On the total capital employed of 47,000 crores, we already saw that the company's debt is very low. Therefore, whatever capital employed would be the shareholders' money. So 47,000 CR was employed into the business. On that, the company earned 10,700 crores of EBIT, earnings before interest and tax, which works out to around 22%. And we see an upward trend in the return on capital employed. If we look at the last 5 and 3 years average ROCE also, it was quite high at 24 and 25.6%. The current 2019's ROCE seems to be below its average, but it is still very high. Next, let us look at the return on assets, that is on the total balance sheet size or all assets, how much net profit was earned on it. In March 19, the total ROA was 11.9%, that is 7,600 of profit earned on the total balance sheet size of 64,000 CR. So this is a good ROA percentage. 16 it was 12.7 and March 14 it was 9. So the ROA percentage has been increasing through the years. The debt to equity ratio would be 0, that is it would be a debt free company, because we have already seen that in March 19 the total debt was just 160 CR against the total equity contribution of around 47,000 CR. So this has been always a debt free company from March 14 at least. Equity is contributing around 47,000 CR of the total balance sheet size of 64,000 crores. That's a 73% contribution from the equity shareholders or the owners of the company, which has been always a very high value throughout the years. If you look at the debt percentage also, debt has always been very low percentage of the total balance sheet size, and in March 19 it was just 160 CR. So we can see the debt has been dropping. In March 14 the total debt was around 2,000 crores, which has reduced to just 160 in March 19. A very good value when we want to invest in a company which is debt free. Price to book ratio, the valuation ratio that we are using to compare what is the market cap what is the value of the company in the market against its actual net worth or the book value. Here we want to buy at below 2.5 times. Currently the price to book is at 3.1 times. Its actual net worth is 47,000 CR against the market cap of 1,47,000 crores. We have to wait a little bit for the valuation to drop to below 2.5 or near to that. So as of now it is at a very good price to book ratio compared to March 19 of 4.3 times. Debt to net profit ratio again would be very comfortable. That is very small, 160 CR in March 19 against the total net profit of 7,600 crores. Just a 2% of the total net profit. Let us see how much fixed assets the company has. It's occupying around 24% of the total assets. 15,000 crores of net fixed assets out of the total assets of 64,222 crores. And if we see the overall trend of the total net fixed assets has been decreasing from 34% to 24%. So overall we see a very gradual trend, upward trend in the fixed assets. So this is a very good thing to note in the green, that the company's assets have been increasing but at a gradual pace. We don't want a very haphazard or a very high sudden growth in the net fixed assets. And the total balance sheet size also has been increasing from March 14 to March 16 to March 19, and therefore the percentages are dropping of the net block. Around 1,600 crores of current capital work in progress is going on. That is, this much work currently going on developing fixed assets of the company, which is just 2.5% of the total balance sheet size. Let's look at how much is the investments as a percentage of total assets. March 19, company's investments were 37,000 crores, a very high investment percentage if you go to see. So 58.4% of the total assets was occupied by investments. These are the investments in mutual funds or shares or so anything which generates other income. And even if you look at March 16, it was quite high at 47.7%. If the company doesn't have anything for capex needs immediately, they can do the investments. And if we see from 14 to 16 and 19, the amount of investments that are there as a percentage of total assets is very high. Debtors are very low at 2,300 CR out of the total assets of 64,000 crores. That's just 3.6%. I would not want the debtors percentage to exceed 30. That's my benchmark. March 16 also it was quite low at 3.1. March 14 4.7. This shows efficiency of the company in keeping the value of debtors or customers from whom the company still has to collect payment at a very low level. So this is a good number. Let's look at the debtors turnover, comparing sales against the debtors or customers from whom the company still has to collect payment. March 90, it was a very low percentage of 3. Out of the total sales of 86,000 crores, only 2,300 was pending for collection from customers, which is a very low value. Even if you look from 14 to 19, we see a very low value, and percentage wise also it's very low. Here too, I don't want the debtors to exceed 30% of the total sales. And if we look on the right hand side, in March 19, it's just taking 10 days to collect payment from these customers, and that's a very small number of days. So it is very efficient, not only in terms of keeping the amount of debtors at a low percentage, but also collecting it at very fast pace. And if we look 16 to 14 also, it's a very low number of days that it's collecting its payment. Cash holding is a very small percentage throughout the years. If we see, it was very small amount and next to negligible. Current ratio has always been below 1 for this company. Its liabilities or current liabilities have always been more than its current assets, and therefore it needs to dip into its investments or any external borrowings to service this current liability. So in this particular portion, it seems there's a problem. But if you look at in a counter view, if you have a counter view on the same thing, then what it means is that the company is enjoying a lot of credit from its suppliers, and therefore its current liabilities is more than its current assets. So basically this could be turned around and looked in a positive manner, and we can also say that the company enjoys a lot of credibility from suppliers, and the suppliers are willing to give it more credit because suppliers are confident that the company will pay them back. Therefore, if we look at the trend, it has always been going higher and higher. That is, the liabilities have been increasing against the current assets, but the company would always be in a comfortable position to pay off these. Inventory holding as of March 19 was around 3,300 crores, which occupies around 5.2% of the total assets. Now this is also good value. We don't want a very high inventory value in the company, as that could lead to losses in terms of price drop or increase in cost of go down storage, etc. So overall, percentage wise also we see that it has been always very stable throughout the years. Inventory turnover, that is how much was the sales against the inventory holding. So we see a very high multiple of 25.9 times, meaning sales were 25.9 times higher than the inventory holding. So this is a good number. Even in March 16 it was 18.4 times higher than the inventory, and in March 14 the sales were 25.3 times higher than the inventory. So the company is keeping its inventory holding at a comfortable position compared to its sales, and we see quite a stability in terms of these numbers. Let's analyze the cash flow statement. Let's look at the net profit and compare it with how much cash is flowing from operating activity. That is, against the net profit is the company receiving cash. In March 19, company's cash inflows were 14% short of the total net profit, meaning the company had shown a profit of 7,600 crores, against which its cash that came through operating activity was just 6,600 crores, which is a shortfall of 14%. I generally look for a higher cash inflows than the net profit, which we can see in March 16 and March 14. In March 14, the cash coming in through operating activity was 75% more than the profit declared. And even in 16, if you see 54% higher cash coming in against the total profit declared. So only in March 19, the company's cash holding has fallen short. Let us look at the long-term trend of net profit and CFO. So if we look at the last 3 years total values of net profit and CFO, we see a comfortable 24% higher cash coming in against the net profit. So at least in a long-term chart of net profit and cash flow from operations, the percentage of cash coming in is higher than the net profit. And 5 years also we see 35% higher cash inflows, and in last 7 years total 40% higher cash inflows. And if we look at the amount of cash that is coming up, it's always more than 20% higher than the profits over the number of years that we are analyzing in terms of trend. Now out of this cash that the company has earned, how much of that cash it is putting in investing activity? So in March 19, the total cash earned from operating activity was 6,600 crores, and 54% of that, that is almost half of that, was put into investing activity, that is 3,540 crores. I would generally want the company that I'm investing in not to put more than 50% of its cash into investing activity. And now this investing activity in this particular chart includes investments in mutual funds, shares, and also investments in fixed assets of the company. So this is a comfortable position in March 19. In March 16, company had put in 85% of its cash in buying assets as well as doing investing activity. So it's a big portion of the cash earned. In March 14, almost everything that the company had earned as cash was reinvested back into investing activity. So if the company has growth, then it can put more money into investing activity. But otherwise, in a normal situation where there is no capex to be done, we do not want to see company putting in a lot of money into investing activity. Let us look at the long-term trend of 3 years, 5 years, and 7 years, where the cash flow from operations was compared to its investing activity. In last 3 years, 73% of the total cash earned was invested or put into investing activity. And we see the similar trend over 7 years and 5 years also. Let's recap the valuation ratio. The price to earning currently is 23.8 times. So this is below my benchmark of 25. Price to cash is 22.3 times, again below my benchmark of 25. Price to book is above my benchmark of 2.5. So the current price to book is 3.1 times. And market cap to sales is 1.7 times. A very reasonable market cap to sales valuation. So if we ignore the price to book, and even if we consider price to book of 3.1, which has already fallen from where it was in March 16, a higher value, then we are getting it at a reasonable valuation. But when we look at the chart or graph, and when we analyze the relative strength index along with support and resistance lines, then we will be able to understand where we can buy, where we can put our buys, or where at what positions can we buy into the company. Moving on to the quarterly P&L account analysis, let's understand how the sales and the profits have been growing YOY as well as quarter on quarter. So first we'll look at the sales growth. YOY sales has grown by 5.3%, and at the same time the profits have grown by 4.1%. Over December 18 to December 19, both the sales and the profits have shown positive values. Quarter on quarter, if we look, September 19 to December 19, sales has gone up by 21%, whereas profits have gone up by 14.1%. At least in the quarterly analysis up till December 19, both the sales and the profits have gone up considerably. Finally, let's look at the net profit margin on a quarterly basis. Over the different quarter data that we have of December 18, September 19, and December 19, the company's average net profit margin was above 7.5%, which is a good value considering that over the years when we analyzed initially the annual net profit margin figures, there too it was always supposed to be somewhere around this level. So the company is managing to maintain this level of NPM. this concludes my analysis of Maruti Suzuki Limited's financial statements. Let's look at the core ratios and then move on to analyzing the technical chart. So I'm comparing for core ratios Maruti Suzuki with Mahindra and Mahindra. Now the format is the same as usual with all the videos. The current market price for Maruti is 4,646 rupees per share, whereas Mahindra and Mahindra's current market price is 294 rupees. The results are up to date till December 2019 for both the companies. The quarterly sales YOY, Maruti Suzuki has seen a growth of 5.29%, whereas Mahindra has seen a fall of 4.45% from where it was in December 18. If you look at the profit change YOY, Maruti has seen a 4.13% increase in its net profit, whereas Mahindra and Mahindra has seen an 85% fall. So now this needs to be investigated as to why there is a fall in Mahindra's net profit from its previous quarter. In previous quarter it had earned 1,300 crores, whereas in the current December 2019 quarter the profit declared was just 200 crores. So this needs to be seen as to what is causing such a massive fall in YOY profit growth. If we compare the recent 12 months sales with its 2019 sales, in 2019 the total sales was 86,000 crores, whereas in the recent 12 months the sales has dropped to 78,000 crores. So here Maruti Suzuki has seen a fall from 2019 in its sales. Mahindra's sales has also dropped from 1,04,000 crores to 1,02,000 crores. Going to this profit figure and comparing it with 2019, in the recent 12 months the total profit declared was 6,183 crores against 2019's profit of 5,900 crore, and for the entire 12 months the profit has increased from 2019 although sales has dropped, whereas Mahindra's profits in the recent 12 months has almost dropped by 50% from 5,169 crores in 2019 to 2,282 crores in the recent 12 months. So here Mahindra has seen a lot of pressure on its profit margins, and even if you look at the sales to profit values, Maruti Suzuki is doing much better. If you look at the 2019 sales value, 86,000 crores of sales and 5,900 crores of net profit. For Mahindra and Mahindra, 1,04,000 crores of sales and 5,100 CR of profits. So here margin or net profit margin is lower for M&M. Let us compare the profit of 2019 with how much cash the company received. In 2019 the profit declared was 5,900 and the cash coming in was 6,600 CR. So this is good because we want the cash coming in to be more than the profits. Now when we analyze the graph, it was the other way round, because in this particular core ratio analysis which I have taken from screener.in, the profit calculation, the profit after tax calculation excludes the exceptional gain or exceptional losses that the company may have considered while calculating. So when we analyzed the graph previously, I have included all exceptional gains, all exceptional losses in that analysis, whereas here I have excluded, or screener has excluded, the exceptional gains and losses. Mahindra and Mahindra declared a profit of 5,100 CR, but the cash had an outflow of 4,300 CR. I generally don't like to invest in companies which have negative cash outflow, that is from operating activity they don't receive money. So here what has happened is, not only has the company not received this 5,100 crores of profit which it showed in the P&L account, but over and above that there was a cash outflow of almost 4,300 CR from its business operations. So this needs to be investigated if somebody wants to buy into M&M. I generally avoid when I see negative cash flow from operations. Let us see how much fall each company had. Maruti Suzuki has fallen around 40% from its 52-week highest price point. That is, in last 1 year, what was the highest point it had reached, and from there how much it has fallen. M&M has seen a 57% fall in its price. Next, let us compare the price earning with its averages. Maruti Suzuki's current price earning of 22.6 times is very near to its averages of the last 5 and 3 years of 24 times. Now again, as I said, here there's a change, or there's a slight difference between what is being shown here and what we analyzed earlier in the price earning. That is because, as I mentioned, here the earnings part considers, in this particular analysis, the earning part of price earning excludes all exceptional gains or extraordinary gains and losses. And there in the previous graph where I analyzed, the price earning values were different. That was because even the exceptional or extraordinary gains and losses were considered in the profit after tax value or the earnings value. So for time being, just consider this, that the current price earning is 22 times and the averages are around 24. So we are getting it slightly below our averages. M&M is available at 15 times its earnings and averages were somewhere around 13.7 times. So it is still above its average. Anyways, I would avoid my M&M because it had a negative cash flow from operations in 2019. But when we look at the 5-year data, at that time we can reconsider if that is a 1 year's aberration. Price to OCF is also very important. Here Maruti Suzuki's shares are available at 21 times more than its cash earnings, whereas M&M's OCF was negative, which we saw earlier. Therefore the price to OCF would also be negative. Price to book wise, M&M is trading at a huge discount to its book value of 0.89 times, whereas Maruti is trading at a premium of 3 times its book value or its net worth. Price earnings to profit growth rate, PEG ratio of 5 and 3 years, Maruti Suzuki is 1.2 and 2.5. The recent 3 years has seen an increase in the PEG value. I want it to be below 1.5 at least, so that I get it at a good price earning. So if you look at the 5 years profit growth rate, the profits were growing at 18.8%, whereas in the recent 3 years it has slowed down to 8.7%, whereas Mahindra's profit has grown at 18% in the recent 3 years compared to last 5 years growth rate of 3%. As of now, I am not considering M&M. This is just for analysis purpose or comparison purpose that I have selected M&M. Sales growth for both 5 and 3 years for Maruti Suzuki were above 14%. That is, its revenue were growing at 14% compounded over both 5 and 3 years. M&M has also seen its sales growing at 7 and 11%. Return on equity for Maruti was 13.3% in 2019 compared to its averages of around 15%. So ROE for 2019 has fallen below the average. I generally want the ROE to be above 15%. M&M ROE is 13.4%, almost similar to Maruti's. Its averages for both 5 years and 3 years were below 15%. ROCE, return on capital employed for Maruti, was 18%, whereas M&M's was just 13%. Here the Maruti is doing much better than Mahindra's. Even if you look at the 5 years and 3 years long-term ROCE values, it is above 20%, whereas M&M's is just 13%. Return on assets of the recent 12 months were 12%, whereas M&M's is just 4%. Whereas if you look at 5 years average return on total assets, it's 15 and 4%. So here there's a lot of pressure on M&M in terms of generating returns, or profitability ratios are very poor. Maruti Suzuki is turning over its assets into sales by 1.82 times, which is a good value considering that Mahindra and Mahindra is not able to generate sales when compared to the assets that it is holding. In terms of inventory turnover, Maruti's inventory holding has been turned in 2019 by 26.5 times into sales, whereas M&M is holding a very high inventory value when compared with the sales it has done in 2019. If you look at the inventory turnover 3 years back, at that time also it was turning over inventory 21 times into sales. That is, its sales were 21 times higher than the inventory shown in the balance sheet. Here for Mahindra it was 9.3 times again. Let us look at the 5-year profit after tax value and compare how much cash the company has earned from operating activity, and then finally look at the free cash flow it is holding. Maruti profit in last 5 year earned was around 26,000 crores. On that, the cash coming in over the 5-year period was 43,000 CR, which is almost double of the profit declared. And out of this 43,000 CR, 26,000 is free to be used in the financing activity. That is, the balance of 43 minus 26 was used in buying assets for the company. So this is a good value over the 5-year period. Comparing Mahindra and Mahindra, total profit declared over 5 years was 20,000 CR. The cash over last 5 years was negative 42 CR, meaning nothing of this profit can be shown as cash by the company. Over and above that, 42 CR has gone out in the operating activity. And if you look at the free cash, it is negative 26,800 CR, which is a very high value considering that they have not generated cash over these 5 years. So this value is very poor, and I would avoid Mahindra and Mahindra completely here itself. Average profits for Maruti were 5,200 CR and Mahindra and Mahindra was 4,000 CR. So this thing is very important to see. If the company is showing profits, why is it not receiving cash? Or if it's not receiving cash, then why is it investing so much in its assets, in buying assets? Let's look at the market cap and net worth. If somebody wants to contribute to my knowledge and tell me what is that Mahindra and Mahindra is doing with its cash and why it has so much of negative free cash of 26,000 crores, why is it investing so much in its business? Is this a good thing or a bad thing? If you could just comment and let me know. Moving on to the market cap to net worth, Maruti Suzuki's market cap is 1,40,000 CR. M&M company's market cap is 36,000 CR, and it is even fallen below its net worth of 41,000 CR, whereas Maruti's net worth was 46,000 CR. Looking at the contingent liability, Maruti's contingent liability was somewhere around 10,000 CR, which is almost 25% of the net worth, whereas Mahindra and Mahindra's contingent liability was around 4,900 and 10% of its net worth. When we look at the debt to equity ratio, we see that Maruti is almost debt-free company, whereas Mahindra's debt to equity ratio is 1.6. That is why we can see why its free cash flow is so much negative, is because not only have they invested everything that they have earned in cash, rather the profit that the company had shown, there's nothing to declare it in terms of cash, and over and above that, using debt, they have invested 26,000 crores in purchase of assets or capital expenditure. Now this needs to be really investigated as to how this company is growing or what is it investing in terms of capex in the business. Because the debt of Mahindra is so high, the coverage is automatically very low. That is, they are paying a very high interest cost when compared to the EBIT it is earning, whereas Maruti's, being a debt-free company, has a very high coverage of 70 times. That is, EBIT is almost 70 times of the interest it paid. Promoter holding of Mahindra is very low at less than 20%, whereas Maruti's promoters are holding 56%. So this gives me confidence that Maruti is a good buy compared to Mahindra, because the owner's stake in the, or the promoter's stake in the company is also very low. So it becomes more risky. Pledge wise, Maruti's promoters have not pledged anything, and there's a mild small pledge of Mahindra promoters. Maruti and both Mahindra have maintained their debtors to sales percentage at a low value, considering that Maruti has done much better than Mahindra's debtors to sales ratio. In terms of collection from customers, Maruti is collecting payment from its customers in less than 10 days, whereas Mahindra is taking almost 32 days to collect payment from its customers. So again, there is a red flag here. NPM margin is at 8.89% in 2019 for Maruti, whereas Mahindra's NPM is at 5%, much below Maruti's. Dividend yield for Maruti works out to around 1.72%, considering the current market price and last year's dividend, whereas M&M dividend yield is higher at 2.7. But this dividend will not make sense because there are a lot of red flags in Mahindra and Mahindra's core ratios. So we should avoid Mahindra. That's my understanding. So I conclude my analysis of the core ratios here. Let's move on and look at the technical chart and see where we can buy into Maruti Suzuki. Let us look at the chart of Maruti Suzuki. Here we can see that in September 2018 the RSI had come below 30 line and the price was 7,300. So I would want to buy at this price point of 7,300, and even if you had continued buying from 7,300 till 6,600, which was there in Feb 19 also, all the way, but using my system I would stop at this price point of 7,300. Basically I would buy 7,300 and 6,600 and then I would stop. After that I would buy straight away at 5,000 rupees, which is the closing price on 20th March 2020. So I have drawn support and resistance line for Maruti Suzuki to buy at these levels. So I'll quickly go through these levels. On the upside, from current market price of 4,600 rupees per share on 27th March 2020, I have levels that if the price does go up to 4,900, 5,800, 6,600, 7,300, 7,700 and 8,500. So I'll buy at all these levels if the price does go up. And on the downside I have levels of 4,600, 3,400 and 1,800. So these levels are, according to me, very difficult to reach these lines. So if it does come down below, I would buy. And even if you see, we don't need to necessarily not buy these gaps also. If the price falls by 10%, that is around 500 rupees, we can always consider buying at a gap of 10% down, going down. We don't need to wait for the stock to fall to 1800 to complete our buy. So even if it's falling by around 10%, we can put in our price targets and buy as it falls every 10% from here, from 4,600 rupees. And if it does go up and we don't get to buy down below, we can always buy at these levels of 4,900, 5,800. And if somebody wants to buy in at a 10% gap upside, that is also possible. I don't discourage anyone from buying up also. I prefer buying low if the company is very good, to get a better average and also to get out early as the price moves, as and when the market condition improves. So this company is very good, and there's no risk in this company as such, of what I understand from the fundamental analysis, and we can buy or we can average as the stock moves down, provided that we have a fixed target as to how much we want to put into this company and how we are going to buy, at what levels we want to buy into this company. So having a very clear picture of how much you are comfortable investing into this company and at what levels down as well as up you will buy to consume all the capital that you want to put into this company. So this concludes my analysis of Maruti Suzuki's technical chart. I have explained you all the company's financial statement, I have explained the technical chart, I have also explained what the company does and everything in all. You take a good decision based on these things. If you have any comments or suggestions, do write in. Thank you for watching this video.